Hey folks, Dan Frio here with your rate update for October 5th, 2023. So here's where rates ended yesterday. We had a little reprieve, not too much anywhere, but let's get over to the news to see what the markets are expecting right now. And I can give you maybe a little bit of guidance what's going on with mortgage rates. So let's get over to the stock market and CNBC to see what the futures are doing and what's going on so far. And you have nothing but red across the board. So why is all this taking place? Well, basically the markets are flat other than the NASDAQ down, it's down 100. But the Dow Jones falls nearly 100 points with investors on edge on Friday's job numbers. So everybody's basically on pins and needles right now, waiting for the jobs numbers to come out. And what are we expecting? Well, unfortunately, right now, good news is bad news and bad news is bad news. Let me explain. Right now, the Federal Reserve, they want more and more people not working. Okay, so right through here, you can see the Fed's long-term standing belief is that a job market with strong hiring and increased wages typically fuel higher inflation. Okay, so they came out even last year and said, we plan to inflict pain on households out there when it comes to jobs and shelter. Okay, so we're all anticipating what that number is going to be on Friday for the jobs numbers. But let's go over some of the data that we have today. So what you're having today is initial jobless claims. It actually came in higher, but not as high as expected. So last reading, we had 205,000 people filing for first-time job claims for unemployment. The expectations were to increase to 210,000. It actually only increased to 207,000. But if you really take a deep dive into these numbers, let's go over to it. Here's a website, and I'll put this data down below so you guys can do it on your own. If you look at here, ADP payroll numbers came in yesterday, and they were just off the charts. They were bad. Okay, if you look back just in, what would this be? In June, there's about 455,000 people got new jobs. Okay, what are we seeing right now? 89,000. It was basically a fraction of what was anticipated. Now everybody keeps coming back saying, okay, now what is tomorrow's numbers going to be with this economic data that we have? Hourly earnings, because again, the Fed wants people to earn less money, non-farm payrolls, and the unemployment rate. So if you go to this, let's first look at average earnings. We go through here and look at average hourly earnings year over year. Pretty dismal, okay? Last June is when we kind of peaked out. Well, it doesn't even come on this chart, but look how hourly earnings are starting to come down, okay? This is what the Fed wants. The other piece of this puzzle is that we were looking at is non-farm payroll. So we go back through here and let's look at non-farm payroll. Right through here, another section where you look back in January and it was robust. Then it started coming down. Fed was cheering this and then it increased a little bit. So this is the numbers that they're looking at for tomorrow. So they want, like I said, more and more people not working to help unfuel the market on what inflation is doing right now. So with that all said and done, that's basically all the data that we have out for today as initial jobless claims. Tomorrow's report will come out. All these reports will be out before I do my video. So just giving you an idea, I think the hours early earnings are going to be kind of right in line. I think I have no clue on what the unemployment rate is going to go to or non-farm payrolls, because ADP came in yesterday and they had, the expectations were 153,000 people were going to get hired and there was only 89, but their numbers are pretty bad. So we're going to watch this meticulously tomorrow, the unemployment rate and non-farm payrolls, because if this number is really bad, meaning it's up way high, meaning that's bad English, but you get my point. The Fed wants the unemployment rates to go up and more people not to be hired. So with that out there, what is the bond market looking like right now on all this data? So right through here is where we have the bond markets right now, the MBS. So I highlighted the MBS market because I want you guys to understand something. We don't follow the 10-year Treasury. We follow the MBS market, what you're seeing right here. Why? Well, the MBS market is basically a mortgage bond trading on Wall Street. That's yield is the biggest component of your mortgage rate. Okay, so right now we see it's up 2 ticks. Well, basically it's just flat. But what I want you to understand is the dynamics behind all these lines through here. So the lines you're seeing right through here, the green line is a 100-day moving average. The red line is a 50-day moving average. And the blue line is a 25-day moving average. So when we analyze all this, it's called Fibonacci levels, we notice that we are way below where we should be. Okay, so what does that mean? Well, it means the prices of this bond need to go up to get back to the averages. So we can even go back 6 months. Here, let me click this, 6 months. This is how far off we are, folks, than the averages. This is how far off we are, okay? So we are way off the averages. All right. So what this is telling us is the bond market has way overdone the sell-off. Okay, so what we need is prices of these bonds to go up, which we're probably going to start seeing here soon. People are covering their shorts on their bond trades. And I'm not going to go over that. If you ever watch the Big Short, you might understand how shorts work. But a lot of people are having to cover their positions right now, making this market even a little more volatile. So what that means for rates is right through here. We're probably going to see rates completely flat today. And tomorrow's going to be the big day, like I said, because of the economic data that we have on employment. But what these rates represent right here, this is for anybody looking to buy their first house or a home. And here's what it is. It's a first-time home buyer buying a primary home, and it's a single-family home. Those three things. Okay, the next thing is the person has a 740 credit score, and they're putting down 20%. So that's what basically right around where your rate would be. Okay, so you're like, Dan, do I need all those criteria? Well, no, you don't. Let me explain this a little bit to you. If you're, to qualify for an FHA loan. Now, FHA loan only requires that you put 3.5% down if you're looking to buy a house. Okay, so you only need, for an FHA loan, you only need to really put down 3.5%. On a conventional loan, like you're seeing up there on the 30-year fixed, if you're a first-time home buyer, you only need to put down 3%. If you're a repeat buyer, you need to put down 5%. So you don't need 20% down, and you don't need a 740 credit score to qualify. If you want to find out how much you would qualify for, or do you even qualify, well, please check us out at therateupdate.com. Here's my website. There's multiple ways to reach out to us. First, there's the Apply Now button. You can click that. It's going to go through a series of questions for you or with you. Based on the answers to those questions, I'm going to vet you to the specialist on my team that'll specialize in exactly what you're looking for. But if you're out there and you're like, Dan, can I call you guys or email somebody just my question? Absolutely. What you want to do is go to the bottom of my website, and here it is. You can give us a call at 844-775-5626, or you can email me directly. And yes, this is me directly, and I will be personally emailing you back. You can email me at dan@therateupdate.com. Thanks so much for watching, guys. I'll see you tomorrow, because tomorrow's going to be a big day. If you haven't yet subscribed, please do down below if you find value in my channel. Take care. God bless. Have a fantastic day. Bye-bye.